This is the Value Investor Podcast with Tracy Reinick. All things value, all the time.
Welcome back, value investors. So I saw an interesting article the other day that I know all value investors would be interested in, but just any investors in general. And it was from Barron's, and it was an article discussing about Warren Buffett's sale of Apple and whether or not he sold too soon. Because Apple now in the week of mid-October, this is October 22nd when I'm recording this podcast, it is broken out to yet another new all-time high. It did have a sell-off into Liberation Day, but it's reversed all of those losses and has now retaken its last high, which was in December of 2024. And so Barron's was asking, did Buffett leave all this money on the table when he started to get out? What was it in, like late 2023, early 2024? Maybe it was early 2024 when he first was selling his Apple shares. It's been the last couple of years when he sold those big chunks. So then it brings up the question I had immediately. Well, one, are we at some kind of top? Because the questions about Buffett's investing capabilities are starting to be asked. Like this question was, like, did he get out too soon? Why is he sitting there in all cash? And you would see questions like that, like at the top of a bull market, right? We had those same kind of questions in the late 1990s about, what is Buffett doing? Why doesn't he own Cisco or any of these other, tech giants? He's missing out and all of that stuff. And then we had the big sell-off and he didn't look so dumb then. But now we're getting asked, he is in the trade, but did he sell part of it too soon? But it comes to the bigger question that we all are having now as this bull market extends for yet another year here in 2025. And that's not a bad thing, but when do you sell? When do you know to sell a stock? And I've had a couple other questions about this with various people that I've been talking to about this year's the sell-off into Liberation Day. A lot of people got nervous then with the tariffs going on, and they did sell some of their big winners. And now they're, talking to me and saying like, oh, I lament selling XYZ back in April because now it's broken out to another all-time high. Or what if you are in some stock that has been just a phenomenal return over the last, say, 5 years? And it's not even like one of the tech stocks. What do you do in those situations? How do you know when to get out? So let's take a gander at maybe what was some of Buffett's thinking on Apple. And this might apply to a lot of the Mag 7 stocks, which have had these huge rallies. Now, Buffett originally said that his sales of Apple were due to tax reasons, but let's say that wasn't the case. And he is a value investor, as you know, and Apple is not really a value stock and hasn't been for a number of years. It was trading with a forward PE of under 10 when he originally bought it in 2016. And now here in 2025, ahead of its upcoming earnings, its forward PE is at 33.5. And even for Apple, that's a bit of a stretch on the PE. But I know some people don't want to use just the earnings side of the picture. So looking at price to sales, the price to sales ratio on Apple right now is at 9.5. And a price to sales ratio of 1 and under is a value proposition because remember, price to sales means you are paying, in this case for Apple, we're paying $9.54 for every dollar worth of sales. And so the market is really putting a premium on those sales here. But what is sales growth expected to be this year? It's expected to be up 5.9% and then another 5.5% for next year. And 2024 sales up just 2%. Now, Apple has never been one of the big mega growth tech companies because it's on the hardware side and then it's got content. It sells a lot of iPhones and iPads and watches and things like that. But at the size that it is, it's just very difficult to do double-digit sales growth. Now, we do have some others that are managing to do it, but it catches up with you at some point. And there's nothing wrong with single digits, 5.9, 5.5, 7, 8%. That's more standard for these older companies. But it does matter what you pay for it. And right now, the street is willing to pay a lot for it. In 2026, Buffett was willing to pay a lot less. And for value investing, that's when it really pays off. It pays off to get it at the cheap valuations, a price to sales, maybe even under 2 or something back in the day. And then he wrote it to these new highs, massive breakouts, but now is lightened his position and taken some of those gains off, because when you get a stock trading at these kinds of valuations, you better have the double-digit sales and earnings growth to back it up. Because again, eventually the valuation will catch up with you. So he hasn't sold off his entire Apple position. The Barron's article indicated that he might have left $50 billion on the table by selling it, the part he did sell, as early as he did. But nobody has a crystal ball, and you're never going to time it correct at the top. Just like you probably won't time it correct at the bottom either, but certainly not at the top. And I've always told people, if you have the position, it's making you nervous, or the valuations are now very stretched, or there seems like there's speculation in it, or the business model has broken down in some way. Like you were getting 20% growth on earnings every quarter, and now you're getting 5, or you're getting negative earnings. I just had a stock we had to sell in the value investor because the earnings have really broken down. I still really love the company, but you can't look away from what's happening on the earnings side. And that stock is Builders First Source, ticker BLDR. And they are like a Home Depot, but only for professionals. So they'll sell the lumber, the appliances, anything that the builder needs to build the home, the apartment building, whatever they're doing, the home renovation, all of that. And they're nationwide in the United States. And they were cheap when we bought them. They had a great pandemic. But now that home sales have declined and new home builds are at multi-year lows, actually, then there's just less builders going to Builders First Source to buy things. They also have tariff issues that they're dealing with as well, but there's a lot of noise there, and the estimates have just really come down. So last year, earnings declined 20.8%. This year, expected to decline another 41%. So kind of falling off a cliff this year. And that looks to be a little bit improving for next year, but this is kind of the hope trade. Nobody really knows if housing is going to rebound a bit next year. It may, as the mortgage rates come down, or it may not, because the builders right now are talking about consumer confidence being not so great, and that is really driving home purchases, new home purchases. But we do have earnings growth of 6.5% expected for 2026. We'll see. But this stock is now trading with a forward P of 18.7 because while the shares have come down, they haven't really collapsed all the way, not even close. They're not back to 2022 levels, let's say. They're not even back to like mid 2023. So this is like the trap picture, but the shares aren't even that cheap. Price to sales ratio, though, it's at 0.87, but PE is still at 18 as those estimates come down, but the stock hasn't really. So something like this is easier to determine, like, hey, maybe we need to get out of this. The Zacks rank has been terrible. It's been a 4 or a 5, a sell or a strong sell for a while now. Right now, it's still at a strong sell. That also tells you that those analysts just keep lowering. We're going to get earnings soon on Builders First Source, so we'll see what they're seeing out there, but I don't expect much to be changing with what the earnings scenario looks like or sales scenario. So, but we didn't have this really with Apple. We have the high valuations, but we don't really have the complete, signal that things are not going well in the actual business like we did with Builders First Source. And that's the problem that a lot of people have right now about when do I sell a stock? So a couple other stocks that people have been talking to me about, United Rentals about to report this week. So by the time you listen to this podcast, they will have reported earnings. It had a huge sell-off into the Liberation Day, and now it's had a huge rebound. It's back to new all-time highs, even going into this earnings report. And I know a lot of people who have owned it for many years. They've had big gains. Again, there's nothing wrong with taking some profit off. But earnings have also come down for this year, not as bad as Builders First Source. And we're only expected to see earnings growth of 1.9% here in 2025, but it is expected to rebound in 26 to 9.2. And then we're already getting in some 27s, and that looks like higher as well. So the worst might be over with some of United Rentals' earnings issues. But that doesn't tell the whole entire story, right, about whether or not you should be selling. It's a fairly expensive stock for the business model at 22.7 times. And the analysts often feel that most of the good news is actually priced into United Rentals already, but that hasn't stopped the stock from continuing to rise. So value investors just have to look at what is happening with those earnings and with the valuation and really understanding what's going on with the business model on a stock like this. And again, there's nothing wrong with taking some of your profits off and leaving some to continue to run. Another stock that I know some people have been talking about because they also reporting earnings this week is Vertiv, ticker VRT. I recently did an earnings all-star video with the AI infrastructure stocks. You can go check that out. And Vertiv was one of them. I own it in the value investor portfolio. We've owned it since 2023 and in my own personal portfolio. But it just reported earnings and it was trading near its all-time highs going into the number after a huge sell-off during Liberation Day, massive sell-off. And now it's recovered all of that and it continues to rise. But some people I know told me, like, I sold in the Liberation Day sell-off because I was worried about what was coming in the future. And it was a massive sell-off. So again, it's hard to know what you should be doing on stocks like these that have had huge AI gains Forward PE now on Vertiv is at 45. Now they did beat and raise this quarter, so earnings estimates are gonna go up a little bit here for 2025. But the PEG ratio is at 1.5, so that's fairly cheap because we do have strong double-digit earnings and sales growth expected for both this year and next year. But it's no longer a cheap stock. Price to sales is now 7.3. That's pretty stretched for a company like this, but they do have a backlog of 9.5, and new orders in this last quarter, third quarter, were up 60% year over year and up 20% sequentially. From second quarter to third quarter, sales were up 20. And they do the data center build outs, and the AI story, especially in the data center, the infrastructure side is still red hot. So I am not selling any of these types of stocks, the infrastructure stocks, even with the stretched valuations. But if shares get pulled back on valuation concerns, which it very well may, then I would be buying the dips on this one and not getting out completely. So it varies on the industry what you should be doing. And also remember, if you can't sleep at night, and yes, there's some people who can't sleep at night when they have huge winners because they are concerned about like, oh, there might be a crash coming, or we just had one with Liberation Day. What if we get another Liberation Day and I lose all these gains? If that's the case, if it's causing you anxiety, then there's no reason to be in that investment, whatever it is, or there's no reason not to take some profit off and lock in your profit. You should always be able to sleep at night with your investments. So keep that in mind. And as value investors, we tend to look for things that are not quite as speculative, but some of our value stocks, like some of these I'm talking about right now, have been caught up in this huge bull market now, and they're not as cheap as they used to be. So some cases, they have become a little bit more speculative and have that growthiness feel. And we're not used to dealing with all of that, right? And that's why we get articles from Barron's saying like, oh, Buffett sold too soon. But value investors, we do have a mantra of wanting to buy the cheap stocks and then realizing when they do get too stretched. The stretchiness, the very high valuations, as I said earlier, don't last forever. So timing the top is an art form, nearly impossible to do, but that's why maybe getting out of partial of a position, cashing in some of those gains. Buffett didn't sell all of his Apple shares all at once. He did spread it out over several quarters. So he was getting out at various price points. And again, he is still sitting on a huge position in Apple that is benefiting from this new breakout. But he also has $350 billion now in cash, just sitting there to be deployed into the next value type trade. So I would keep those things in mind when you're thinking about when to sell. Also, another tidbit that everyone should keep in mind, not just value investors, on when to sell is, what is your strategy? What are your investment goals? Why are you in that stock? Why are you investing that money? Did you reach your goal? If you've reached your goal, then that is signaling to you to sell. And perhaps Buffett did reach his goal with Apple, and that's why he exited part of that position. We've seen him exit, various other things as well. And he was selling part of Bank of America shares too, while that was still rising. And I don't really see anyone talking about how much he left on the table with Bank of America, right? Because that is near an all-time high as well. And he was selling that for many quarters in a row, lightening up the load. He still does own some, but he left money on the table with Bank of America too. So this just goes to show you that even the greatest investors can't really time it right. But the goal isn't necessarily to time it right. It's to meet your goal. And if the stock has done what you hoped it would do and it no longer fits your strategy, and if you're a value investor and it's stretched, then that is some good signals that maybe you should be redeploying that somewhere else. Another one, so we've done Apple, we looked at Builders First Source. Another one that was reporting this week that was near its all-time highs is Hilton. Hilton Worldwide, ticker HLT. And when you look at that chart, it actually has a very nice chart. It's trading near its highs, which it hit maybe a couple months ago. It's been on a wild 5-year ride. During the pandemic, these stocks got hit, the hotels, then they had a nice recovery. Then it really went nowhere in 2022, 2023, before this latest breakout in 24, and now here in 25. It did have a Liberation Day sell-off, but it has recovered most of that to hit new highs. It's trading with a forward PE now of 33.5. Earnings for this year expected to be up double digits, 11.7%, and next year another 13.7%. These are very consistent, nice earnings growth. So I'm liking all of that, but it is a little stretched at 33 times. Price to sales, 5.4, and a PEG ratio of 2.6. So none of these scream out value, but you might have been a value investor if you bought it back in 22. Or 23. And now you've had this big breakout, and now the shares are a bit more stretched. This is common with most of the stocks on the stock market right now. And so I'm just bringing this one up because I did see its earnings report, and the earnings look great. So if you're like, should I sell this? I've been in it a while. Oh, but wait, the earnings look good. Then there is no signaling that, that on the earnings and the sales side that you should be getting out. But it is a little bit more stretched. So if you are the value investor, I keep these on my watch list. If we do have a global recession, then these hotel and travel and leisure stocks could get hit a bit. But for now, the luxury side and the business travel seems to be making up a bit for just regular, the rest of us consumers who are traveling and staying in hotels. So Hilton is an interesting case because this shows like just how difficult it is to know when to sell. But again, what is your goal? What was your goal when you bought it? And have you achieved what you wanted to achieve with owning Hilton? So that's Hilton, ticker HLT. So it's a mixed bag with a lot of these. The only one we've talked about that really has, earnings or business issues is Builders First Source. But we did sell that in the value investor, and I owned it in my own personal portfolio where I had to sell it as well. And so I'm going to keep an eye on it. If it gets a lot cheaper, if the shares, do pull back even further than what they have, or the earnings turn around, then I might be interested again. But these other companies, the earnings are looking pretty good. So following the Zacks rank and what the companies themselves are saying, it's hard to be a bear with some of these right now, except possibly on the stretched valuations. So do we have the guts, like Buffett, to take a little bit off the top on some of these great companies that maybe just are a little too expensive now? He did, but he's still in it. He's still in both Apple and Bank of America, even though he's sold off some. And that might be the way to go if you're unsure. nothing wrong with taking profits, as I've said. So let me recap the stocks again we talked about. So, of course, there's Apple, AAPL. It will be reporting at the end of this month of October, so tune in for that. Apparently, their new phone is selling pretty well, so could be, but that won't really be in the last quarter, but it could be a good driver going forward for Apple. And then we talked about United Rentals breaking out to new highs, but maybe not as cheap as it used to be. URI is that ticker. And then Builders First Source, that's the one with the falling earnings. BLDR is the ticker on that one. Vertiv, great earnings, but pretty stretched at 45 times. Ticker V as in Victor, R, T as in Tom. And then Hilton, ticker H as in Harry, L as in Larry, T as in Tom for that one. And we did mention Bank of America as well, also near its highs. Let's look at real quick just at the valuations on Bank of America, because some of the banks are a little expensive now. Now, remember with the banks, you can't really look at PE. Bank of America's PE is 13.7, but you should look at price to book ratios. And the bank analysts always say buy at 1, sell at 2. Anyone who's listened to my banking podcast knows this. And Bank of America is at 1.37. So that's not real stretched. It's not at 2 or even close. So it's not as cheap as some other banks I've seen, but the valuation is still pretty attractive here. So Bank of America continues to look attractive. And maybe that's why Buffett is still holding on to a chunk of it. But Bank of America, ticker BAC. Did I cover everything? I think I did. So when should you sell? That's a hard one, but have a strategy, have your investment goals, have a plan. Plan will make you feel more in control, and that's good for when markets are rising. It's good for when markets are falling. It's always good to have a strategy. And your other strategy should be to subscribe to get the Value Investor Podcast. You can get us on YouTube. Go to Zach's podcast page, sign up over there. You'll get most of our podcasts over there, including ETF Spotlight with Nina Mishra. She's been killing it on topics. She's gotten rare earths. She's had gold. She's had Bitcoin. I think she's had quantum computing recently. She gets great guests. Go listen to her podcast, but sign up on YouTube on Zach's podcasts, and you'll get them all. But otherwise, I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.